So Simon, Bundeep, Reeve, we have a challenge in front of us. Not only we have to be intelligent, but we have to keep everybody awake, right? Is everybody up for it?
Absolutely.
Cool, let's do it, right? So just a quick show of hands in the room. How many of you have a stable coin? Like have any kind of crypto wallet? Yeah, good, nice number. Yeah, I mean, good number, right? Perfect. So you will enjoy what we are talking about. So let's start with the first question. And what we'll do is, Bundeep, we'll start with you, then move to Reeve, and then move over to Simon. Before answering the question, if you could also just briefly explain what your company does, then that's great, because that gives audience the context of what we are talking about. Also, we will come to the audience for questions, so just keep those questions with you. There'll some mics in the room, which will come to you after you raise your hands, right? Also, what we'll do in this session is we'll not use jargon. We'll just make it simple, easy for all of us to connect with each other, right? So real-world assets, we all know gold, treasuries, US dollar, lots of other things. Tokenization of real-world assets, it's simply putting them on the blockchain, because now these assets can be purchased like Bitcoin can be, or a USDT can be on the blockchain. Yield bearing means that they have interest value. That means you're essentially able to get a yield on the top of it. And stable coins, in which the way I simply think about it would be principal is protected in some way, because there is a collateral behind the assets versus they being uncollateralized. For example, BTC is uncollateralized, so is Ethereum. So very, very simple definition, getting this out of the way, right? So starting with you, Bundeep, why are you excited about this space? Why are you excited about real world assets? If you are indeed, you can take a contrary view as well, that you're not excited.
Do you want me to do a quick intro first?
That's right, that'll be great.
Hi, Bundeep Rangar from Fineqia. We are a principal investor. We are also doing generation 3 of the ETF industry, which is not just holding Bitcoin or Ethereum, but deploying the assets on yield-bearing activities, including DeFi. So we'll be launching the first DeFi ETN in the world, hopefully in the next few weeks. And we're working together with Reeve on this master project that involves stablecoins and yield-bearing assets. So why am I excited? Because I think that historically there's some opportunities that come up when there's a paradigm shift in the way we do things. If you look at the advent of e-commerce, it basically was precipitated by the infrastructure of the internet. And I think what's happening now with the blockchain infrastructure, it's preceding new ways to do commerce, and via that, new ways to generate yield. And those were just not possible before. Obviously, we can get into details over the course of the session.
Yeah. Yeah. What excites you, Reeve, in this context?
Well, the entire industry continues to excite me after a decade of being in it, and having the pleasure of concepting and introducing the stablecoin back in 2013, and really seeing how it's paved the way for where we're at today, and become the kind of the foundation of our ecosystem, and to see the evolution. And so now we'll have hundreds, if not thousands, of stable coins that are coming to market. And we'll dive into the real world asset backing of them, and why that is a huge advancement, not only for DeFi, but for traditional finance, and how the merging of the two, very soon it's just going to be finance. There won't really be the clean separation between the two. But stable coins are going to be the foundation of that, and they're going to enable the transition of all of these real world assets onto blockchain technology, which essentially just makes doing business more global, more efficient, and more accessible for everyone around the world. So there's a lot of things to be excited about the future, and all of the excitement around both RWAs and stablecoins, and what they're going to do for the future of finance.
So hi everybody, I work for Copper. Copper is a digital asset custodian at its core, with sort of prime services as well. But my primary role actually is the Chief Commercial Officer of Copper Securities, which is a new business that we bought in Abu Dhabi very recently. And the primary function of that, it's a traditional securities broker-dealer, which is quite unique in some respects for a crypto business to buy such an organization. The main reason being is we see the advent of tokenized securities and various other assets that are going to be tokenized in the future. And we wanted a way, it's a real cliche, but it's true, for our clients to sort of bridge that gap between traditional finance and the crypto ecosystem. And a lot of these new money market tokens, et cetera, that have just been created recently, we are going to provide our clients use cases to use those. So look, I think this is just the start of the tokenization journey and how, to Reeve's point, the traditional capital markets can really be transformed. And we feel we have a lot of the infrastructure to enable that transition to happen.
So here's my challenge to the panelists, right? So everybody here in the room is sophisticated investors, right? They represent institutions, they run hedge funds, they run lots of other sophisticated institutions. And one of their job is to be skeptical, right? Because that's the reason people pay you for it, running family office money, to be skeptical, right? And the numbers get thrown around on RWA is always in trillions. Yeah, trillions of dollars, X will happen, Y will happen. Can you pick a use case? And when I say use cases, it could be treasuries, it could be gold. In your view, which asset class will be tokenized first, which they should worry about, they should care about, they should say, hey, you know what, let me understand and study it, and just go a little bit deeper why, right? I mean, and I think it's important because, again, we should respond to their skepticism even if they are not able to ask us very directly. And Reeve, we can start with you, go over to Bundeep and come to Simon. Yes.
Sure. Well, which asset class was tokenized first was the dollar. That was Tether. We tokenized the dollar and enabled you to move money like Bitcoin globally, instantly, and for free. It's taken a decade for us to get to this point where most of the world accepts it or at least knows about it or interested in it. And now the technology is caught up because in the beginning, from the skeptical point of view, a lot of people are like, well, is the technology safe? Is it secure? Is it easy enough to use? It's getting there. The internet took 2-3 years to really take over the world, to touch everyone in the world. We've taken 10 years because this is the movement of money, not information. So the skepticism is real and it's valid. But when you're asking what are the assets that are going to be tokenized, it's the dollar. And what's the next easiest thing to tokenize right after that? Treasuries, basically dollars that earn yield. And then you just keep going up the level. Soon it will be securities and then real estate. But the challenge with securities and a lot of these traditional assets, why would you put them on blockchain? Like the dollar's easy enough use case because it was hard to move money around the world. But when you look at securities, you guys know this better than anyone. We have a very sophisticated engine in most countries to trade securities, and sophisticated investors don't need that extra oomph that the blockchain, that efficiency that the blockchain offers. So securities will take a little bit longer, and the regulations have to catch up. But that's why I think the dollars and treasuries, and then real estate, which is easily traded, but the regulations and just the paperwork involved with real estate transactions can be significantly reduced by tokenizing. So I think the tokenization of real estate is actually a better use case than the tokenization of securities for kind of the next things that are going to be tokenized.
Yeah. So Reeves, your money is on the US dollar and real estate. Simon, what are you putting your money on?
Again, I relate it back to sort of what we do on a daily basis. And I look at our business and look, we are a crypto business at its core today. But a lot of what we do, we view crypto almost like as a giant lab experiment. And I mean that with the greatest respect. And crypto is our lifeblood. But ultimately, by tokenizing treasuries and these new money market funds like BlackRock have done, Franklin Templeton and other organizations, this is the first step for actually tokenizing, traditional securities. Now, why would you do that? We can demonstrate with the infrastructure that we have at play today at scale. We've got hundreds of clients of hedge funds and asset managers trading in the crypto ecosystem on crypto exchanges and margining positions using primarily crypto assets. But when you can transform that and allow clients to start using yielding traditional securities, you change the whole landscape. Not only is it better for the incumbent clients, it'll attract new players, so new hedge funds and asset managers which have an affliction to holding crypto or frankly are not allowed to hold crypto, to then play in this market. Now, why does that matter? Not that I think that everyone has to trade and participate within crypto, but it then allows you to start to understand why it is a more transparent, more efficient, and ultimately better way for capital markets to operate. Just as an example, when we have our clients margining derivative positions versus exchanges, they're settling every 2 to 4 hours, not T+1, T+2, et cetera, et cetera. And by adding these new collateral types, again, they are traditional securities, That is the first step for the equity market, the bond market, et cetera, to become more and more efficient. Now, not for a second do I think that's happening tomorrow, but I think we're starting on that journey, and I think this is a big step forward for doing that.
Bundeep, your thoughts on this?
A few thoughts. So I think you're right about fund managers and investors having to be skeptical, because I think that one of the agendas for them is capital preservation. But equally important, if not more, is return on investments. And I think there's three shifts happening in the industry. One, I think there is a new asset class that's coming about, which traditional investors are getting acquainted with. Two, there's an increasing amount of new assets being generated from asset classes that were in so far until now very illiquid. And the advantage of tokenization is to create one, liquidity, and two, access, which will then tap into a whole slew of investors that could not buy tokenized T-bills until they were tokenized. And they'd rather hold tokenized T-bills and get a yield than holding a dollar. And the consequence of that is there's a new emerging asset class investor, which is specific to digital assets, right? So we're investors in a company called Wave Digital Assets out of LA, which is one of the top digital asset investors. I have a company I started in the UK which finances insurance premiums. It's funded by some of the top private equity firms, and its loan book is financed by some of the top investment banks. Insurance itself is $1 trillion industry, which most people have no access to, whether it's distribution, whether it's cash flows from annuity streams, whether it's insurance risk or reinsurance risk. I was in a car with someone called Jeremy Collar just a few weeks ago. In the private equity world, as you might know, the biggest exit for private equity is not by selling underlying companies or having IPOs, it's by selling LP positions to other private equity investors. And the top three players in that space are Lexington Partners, Collar Capital, and HarborVest. Now, collectively, there are about $100 billion of private equity interests that are sold to these top three players. That market, according to Jeremy, should be 10 times that amount. The reason it's not is the following. For those of you who followed the previous discussion on Bitcoin and the sort of weaponization of the US dollar, the global currency today is still the dollar. 88% of all trade is the US dollar. And a vast majority of the retail participation in equities is from the US, so it dovetails the US dollar. In the private secondary markets world, unlike stocks, which have 60% retail participation, private secondary markets have a 3% retail participation. And that's through wealth managers and private banks, not direct participation. If you unlock that, you unlock insurance assets. You could have people sitting in the Philippines or Hungary or Mexico accessing the same capital instruments that an investor would have in New York or Montreal. So to me, it's the liquidity creation, it's that ability to access these assets that have so far been inaccessible, and then the generation of liquidity that's driving tokenization. I would add one more thing there, which kind of stitches the two themes together. You can't have tokenization without stablecoins. There is an inherent correlation between the two. Because we're all talking about tokenization and the market's trillions of dollars and whichever stat you want to look at. But the point is that just creates a fractional ownership. That's like saying, I registered a company and it has shares. Well, whoop-de-doo. It doesn't mean shit, sorry, unless someone's going to buy them, right? So if you want to buy these tokenized assets, you need a stable coin. The oracles can set the price of real world pricing with the on-chain asset or the on-chain data of that asset, but you still have to buy them in a currency that the world recognizes. And going back to the previous discussion, 88% of the world's trade is in the US dollar. Hence, you have a US dollar pegged stablecoin to not just price them, sell them, trade them.
So that makes sense. Everybody in that room also worries about risk, right? What if they buy something, this fancy thing called as tokenized asset, and they're the only one who's left holding the bag? There is no other buyer after them. There's not enough liquidity, or who takes charge of the collateral? Something goes wrong, like it's based on real estate, but the tenant defaults, X happens, Y happens. Who takes care of the performance risk, for which there are existing systems in the existing asset class that takes care of it, right? So is it possible for you to talk to the people in the room about risks, right? And also in early stages, when there is not enough liquidity, when there is not enough, let's say, history behind the performance of whoever is managing the tokenized asset, how do they still dip their feet into it, but at the same time not get burnt? Because I've heard, that's one of their concerns. There's not enough liquidity. What happens to the performance? Which regulator or which legal system do they go to when things go, let's say, in the wrong direction? So we'll start with you, Simon, and then we move over to Reeve and to Bundeep.
I mean, look, I think a lot of that depends on your own due diligence of what you're purchasing or whatever. I mean, again, I will speak to the things that we're dealing with the most at the moment, aside from stablecoins, that is, and they are these tokenized money market funds. And I think everybody in this room would be pretty comfortable holding a tokenized money market fund, which is run by BlackRock or run by Franklin Templeton or run by these huge organizations. And I don't think it's going to stop there. I think, even Legal & General announced yesterday they might be doing the same. So I think all global asset managers, banks, et cetera, will continue to create these sort of products because ultimately they are going to be the sort of tier one collateral of the future. And that's the benefit of these things being tokenized and being on chain, is you can move that collateral around the system much more quickly and efficiently than you can in the current system. So I think there's much risk when you're dealing with those sort of organizations. And ultimately, these are securities. They are regulated by the SEC, et cetera, et cetera. The assets that they're holding are short-term T-bills, reverse repo, and so on. So they're custodied at big custodial banks in the US and so on, just as everyone operates in those securities today. So I don't think there's much risk in those inherently, but as you obviously go down or go up the risk curve, then things start to look a little bit differently. But I'm not sure we're quite there yet at an institutional level, and that's why I think it's important to take these sort of small steps, make sure that everyone's comfortable before we move on to the next thing.
Yeah. And also we have entered into a new era. When you think about having myself up here on stage, I'm a true crypto person speaking at a financial conference. And so when you talk about risk, you also think of the years past where it was a lot of gambling, or let's say 90% gambling. People are trying to invest in technologies and ICOs and different tokens and DeFi protocols, but it really was gambling because they didn't have any information. The advancement that we're making is bringing in the traditional side through RWAs. So now that people are comfortable with tokenizations, and if you think about it, we attempted this in 2018 with the STO, the Security Token Revolution. An RWA and an STO is identical, it's just a different term, 6 years later, because the technology's caught up enough where the regulations there, the security of the wallets and the ease of use of the wallets are there, that the traditional people and the larger investors can get involved. So that bucket of risk that's typically associated with crypto is kind of associated with a different type of crypto. So now moving forward with this onslaught of RWAs and these assets being tokenized, it's a different type of risk. The risk that you're going to experience is the same risk when you work in any startup industry or with banks. There's lots of risk there. This is just a new technology that's going to increase the use cases and the yield on the things that you used to do in the past, and it makes it more efficient. It's the jump from traditional mail to email, and now it's the jump from traditional finance to the future of finance utilizing blockchain technology. That level of jump is what this new technology is offering. And so it's just moving really slowly, but it's getting there. So I don't think the risks are going to be any greater than they are in the traditional world. You just add in some technology risks because the companies that are going to be playing in this space are going to be regulated.
Look, every new industry has those sort of teething troubles, right? But that's also where you have the advantage of concept and time arbitrage. If you look at the hedge fund industry in the 60s, it went to the same thing. We're listing our ETN in Vienna on the Vienna Stock Exchange. The Queen of Austria set up the bond exchange because people were illegally trading this in coffee shops. I bet if you asked Reeve, when he started Tether, people would probably have said, who's going to buy this stuff? Like, who's going to buy?
Well, you bought Bitcoins. There's a thing called local Bitcoins where you had to call someone up and they'd meet you in a coffee shop and you'd sell them, you give them cash, they'd give you Bitcoin. Literally, that is how Bitcoin started.
That's true.
Right. And Tether today is what, $110, $115 billion, the most profitable company per person. There's enough liquidity there. So do we want to wait till the markets get liquid, by which it also means they become very efficient? Or do you want to capture that inefficiency now and make the most of it while it's still a nascent industry? That's the real question for investors.
Super. So everybody here in the room is also used to markets being geographically located in one place. So if you want to buy tech stocks, you head out to the US. You want to buy metals, you head out to London. You want to buy Chinese securities, exposure to China, you head out to Hong Kong. For tokenization, where should they go? Which is the best regulatory environment where they would be safe, probably within the constraint B, they'll have the best markets for them to trade, buy and sell and hold? What would your recommendation be?
To be honest, I wouldn't have a clue. I mean,
The lawyers don't have a clue either.
Right.
yeah.
That's a problem.
Yeah. Or which country has the best regulatory framework where the markets will develop the most?
I was going to say, look, there is a real big reason why a lot of folk in this room are, relocated to the UAE to set up crypto businesses and tokenization businesses, and that is because of the frameworks that have been put in place by VARA, by the FSRA, which is the entity we sit under in Abu Dhabi, and they're very forward-thinking and provide a rule book and ways you can engage with the regulator in a much more proactive way than perhaps you can in other jurisdictions. So there's good reason for that, and that's why this area is thriving, and I think it's going to continue to do so.
I think there's like 3 categories there for me too. There's one that are no-go areas because they just don't have the regulations, like India and China are probably there. To me, then there's a second one, which is they have regulations that are potentially progressive, but they don't have the mindset. So what you read on paper is not what you experience when you're there. And probably Singapore falls in that category in some ways for me. The UK probably a bit too right now. And the US for sure right now. Then there's places that are both progressive on paper and in mindset. To me, that's the most important bellwether. The UAE obviously is way up on that list. I think also the Caribbean triangle of Cayman, BVI, and Bermuda are pretty good. And there's an emerging sort of conformity between mindset and legislation in Europe under MiCA. But it's still early because it's going to be live next year, so we'll find out more.
Thank you very much for that. So now we'll go to people in the room. If we could dim these lights a little bit, and if the lights can come up, and we can see whoever wants to raise their hand. If you could tell us your name and the company that you represent and whom you're directing the question to, then it's easy for us to, so I can see a question there. Is it possible to bring the lights up in the room? Then the panelist is able to see everybody.
Good afternoon, Charlotte. Paxos International, we issue a yield-bearing stablecoin from the FSRA framework in Abu Dhabi. Today we are talking to institutional investors. I don't know if everyone knows how stablecoin work, but I would ask the panel today, how do you see in the future the difference made between non-yield-bearing stablecoin and yield-bearing stablecoin, and how will this drive acceptance and usage across the institutional investors?
Reeve, you want to take that? Yeah.
Sure. If I heard the question right, it was how do we see the
differentiation?
Yeah, yield bearing versus non-yield bearing. And it's a great question because stable coins are meant to be like cash and spent. You don't really expect getting a return on your cash. Now, if you want a yield bearing stable coin, that's going to be more in an investment bucket. So I do see the utility of them kind of splitting. Like people are going to want investment that's fairly low return and low risk. And then they're actually going to want to transact with the stable coins. We are rolling out a non-yield bearing stablecoin, but where the minter actually gets all of the yield. And what that does is it incentivizes the minter to be the distributor and really push it out. Because we now have the tools, the Web3 tools, which is the community should be the ones receiving all of the benefit for participating in the community. We have those tools to deliver that. So why is it that these centralized entities are making all of the money? So when it comes to yield bearing versus non-yield bearing, it's also going to depend on really the use cases. And I think that both buckets and both types of stablecoins are really going to grow. There'll be a lot more non-yield bearing stablecoins come out that have very niche use cases in communities that gather around the use case of that specific token that speaks to them. And then the yield bearing ones will become investments for people.
Yeah, and I think I'll also add, you can think of normal stable coins without yield bearing as checking accounts. In the US, they don't pay any interest. But savings account, you're essentially able to get interest in most of the countries, right? So what you may also see, let's assume if stablecoins are successful at scale, then they will start to offer in countries where the regulation doesn't allow checking accounts to be checking accounts to have interest, for people to essentially just shift into yield-bearing instruments because they fundamentally represent the same dollar, but in this case, they will be yield-bearing, right? So there may be some shift that may happen as well.
I would just add, well, Charlotte, congratulations, first of all, on the launch of your yielding stablecoin, and that speaks volumes for this region, and Abu Dhabi in particular, the FSRA, getting that done. There's no question for our business and the clients that we have, institutional hedge funds and asset managers and so on, they of course want to use a yielding stablecoin, no question. The difficulty, again, goes back to regulation, because a stablecoin in the eyes of most regulators is effectively a crypto token, and therefore it can't provide yield. It's sort of as simple as that, everywhere apart from the FSRA, that is, which is great, and we're hoping to be able to get that done. That is really the main reason why we bought this business, to enable us to hold and pledge effectively securities, to enable us to use these tokenized money market funds, as I was talking before, and therefore you have that distinction between a stable coin, which effectively is a crypto token, and a tokenized money market fund, which is a security. So it's the age-old issue of global regulators need to decide what is what and how we can fit them in.
Navin, I'll just add a bit to that. I think, again, the same for a utility versus the savings checking account, what have you. But again, if you want to send money to somebody in the remittance market, you just need a utility. You just want to send cash, right? India and Mexico, the two biggest remittance corridors, they just want to send the money. If you want to get yield, go to investment products, like Reeve was saying. Go to a tokenized RWA money market fund, right? That Sam was talking about. That's where you get your yield. Now, in order to create that tokenized money market fund or private credit fund, you need a stable coin, because how else do you buy it? How do you price it? How do you store it? And if you want to get into DeFi activities around that, I use that as a collateral to borrow or lend, you need a non-yield-bearing stablecoin. You will buy that underlying asset for the yield, but you will transact. The medium of exchange will be a stable-priced digital currency, i.e. a stablecoin.
Yeah, fair enough. Thank you. We can take maybe 2 more questions. Anybody else?
Hello, my name is Roy. I'm building on-chain derivatives. So my question is, we are all talking about real-world asset tokenization, etc. But I always think a little bit far ahead. So I'm thinking already about on-chain derivatives. I'm not the traditional derivatives like future options, like OTC derivatives, grave default swaps, interrate swaps, total return swaps, even new design, new financial products like, for example, impermanent loss swap, right? So my question is, how far or how close are we to get to this point to bring the quadrillion-dollar market in traditional finance on-chain, and also improve on that and design new financial products like complex OTC derivatives at the hedge fund and investment banking level?
I'm not 100% I got the question properly.
I think it's a question of how far are we in bringing these non-tokenized real-world assets and the trillions of dollars on-chain and create tokens.
Do you want to take
If I understood the question correctly?
Yes. Yeah.
Yeah. So, I mean, I think the answer is twofold. Is there a propensity to tokenized assets? Yes. Do we have the right regimes to do that? Probably no. So even for us, when we're tokenizing insurance assets out of the UK, I have to take that tokenized structure outside the UK, probably to Bermuda, and tokenize them there. So if you want to have a huge amount of tokenization of real estate in India or Canada, well, the regime has to reflect that tokenization ability and not have the actors being risk put into jail. So to me, that's the way weirdly, I mean, like we talked about non-crypto conferences. I was at Finovate in New York last month, and at the end of a conference on tokenization, or the panel rather, I did a raise of hands asked to the audience, and probably about 5% of the people, they said they knew what tokenization was. So we have an education curve to go through, we have a legislation curve to go through, and we have to move away from this enforcement action mindset, because unless people feel free and safe, they're not going to do it.
100%.
And the last piece I want to add kind of to that, and also overall, especially to convey the weight and the importance of stablecoins, there's going to be 1,000 stablecoins coming, and that is a great thing because it creates competition. But it's not necessarily competition amongst all those stablecoins. What it's truly going to be competition against is CBDCs. That's something that we have not brought up today, but I encourage all you to learn about them, which I'm sure most of you know. But the governments are going to release their own stable coins, and that's what's going to become kind of a threat to freedom and privacy and true democracy. But it provides ultimate control of the government, which is a wonderful thing for the government and for some section of citizens, because it's a lot of use cases. But what I'm getting at is the future holds a lot of CBDCs. And when there's 1,000+ stablecoins, some of them are going to be able to be utilized as well to ensure that citizens maintain some modicums of freedom and control of their own money. So that's why I encourage just learning and supporting and realizing that stablecoins are a big part of our future, because it's not only the private sector that's going to issue them, but the public sector as well.
So in summary, watch this space. This is going to be an exciting space for you, something that you don't want to miss. Thank you very much, everybody. Thank you.